All right, good morning, guys. Let's get the briefing done here, and certainly back to sort of Groundhog Day here after the back end of last week showed some signs of positivity. Of course, it's all getting given back in style here. I was just saying to Vas, this is like your dream kind of market conditions if you happen to like Fibonacci retracement series, so you can get your fibs all over this stuff. It's hard to know where to start. Let's start with oil. That's actually not hard to know where to start. You start with oil and you end with oil. China news has been has reduced quite significantly, I'd say. Of course, these are the two big features of the year so far, China and oil. But China news, not so much of it recently. Sort of last week, they kept fixing the currency rate unchanged. They've done that this week as well. So the China story's gone off the top, and we've got oil certainly replacing it. So as you all know, spectacular rally into the end of last week, and now a spectacular sell-off. Now we are, we're back below $30. I guess that's the one thing to say to start with. That's been the feature of the close last night. So, I mean, oil dropped throughout yesterday's session. It really got going sharply at the European Open, and consolidation for most of the rest of the European day, but then the downside came in again at the European close and then again at the US close. Down below $30, significantly closing below 30. $30 key resistance at the start of the Asian session, and we've been drifting lower ever since. If we look on the daily chart, it is, it was, we were talking about this yesterday, before the sell-off. We were talking about the fact that, ultimately we're, despite the fact this was one of the biggest two-day rallies in history, from a percentage measure, clearly we were still deep into a negative downtrend. And I didn't quite, I was actually speculating, having said that we're still in a downtrend, I was saying we're probably going to see consolidation, and it's actually difficult to judge where we go over the next few days. But I got that wrong, because there was no confusion over direction yesterday. It was down, and at times heavily down, and we're still on the back foot again this morning. So obviously the key price point is last week's low, and we're still quite a way off that. We're a couple of bucks off it. So, I think certainly today is crucial, given how this market is behaving and the behavioral factors being so dominant. And if you didn't read the Credit Suisse report that we sent out on that yesterday, then dig it out of your emails today. Bass sent it. These markets can track through just unimaginable distances very quickly. I think today's really important. Today, I think we either have another equally large down day and find ourselves back at the bottom, and then we're at serious risk of this market extending its downside this week. Or now that we find ourselves around $30, and I guess $30 is key today, if this market can get back above 30 and just prove that yesterday and I guess this morning was a false breakout, well then I think that might be important for technically just stabilizing the market and giving it a chance of just trading sideways for a bit rather than one way, and that's being downtown, of course. So I think the $30 handle's key this morning, and then if momentum starts building, we could easily be down at the low from last week. It's only $2 away, and I know that's 6% at these prices, but that doesn't matter. So I think it's a very pivotal day for oil, thinking about it from a behavioral sentiment point of view, from a trend point of view, technically. So we'll see. The longer we stay below 30, the more likely we're going to have the momentum pick up to the downside, and we'll see a test of last week's low. So everything's being led by oil, of course, this. So equities getting damaged into the close last night and adding to those moves this morning. I've got a chart here of the S&P, and 1900 was such a massive price point as we went into the end of last week. We managed to rally up to that point. The start of this week, the Asian session on Monday, we were right up there around 1900. Just failed to actually touch the high point from the 19th of January, which was 1907. But ultimately, that turned the corner and were sharply lower. I would say the important price is the 15th of January low at 1849. I know we chopped through it a load of times sort of middle of last week, but I think it is still relevant. I mean, those who are ultra optimistic and want to, look at charts and try and find positives, well, then you could maybe, this is important, we could have a reverse head and shoulders on the cards here if you're into your technical patterns. We'll see, but you could say that this circle there, that's the left shoulder, with potentially this shoulder being tested and holding here on the right hand side. Obviously you've got your neckline, which is the 1900 area, which has been tested a couple of times, and then obviously you've got your head down here. So again, I think technically this morning's important. Are we going to see a test at 1850? Are we going to see a hold? Are we going to see a break? Technically, if we can get back to 1900, let's say by the end of the week, then technically this is looking more and more like a bottom. But of course, we've got to get back to 1900 before you can start saying that. So we're at 18. We're in the 1850s, and direction from here is key. Below 1850, forget this potential positive reversal pattern, and we'll be very much probably fetching up back at 1800 again by the end of the week. So I think technically some of these price points are quite interesting on the medium term. Asian session news flow, not much. I mean, it was really just an extension of the US session. Go to the 1 hour chart. The S&P did sort of dump into the close last night. We broke below the high from the 21st of January. And made a new low for the day, and it really opened out. We lost about 1% in the final hour of trading yesterday for the S&P. That fed through to a negative Asian session, which is it's like a negative feedback loop, because then US futures add to those losses as we go through the Asian session. You can see that the markets like the DAX here, you've had a gap open to the downside, of course, and it's been balanced here. We've been sideways really, but obviously you got a big gap to the upside to make it back to yesterday's close, which was quite a key level because it was the 21st of January high. But 9,500 on the downside. If we do break and make a new low, if oil does track down below 29 bucks, then 9,500 is a psychological level for the DAX. But look, where's all the money going? Well, you can see that it's going into safe haven assets. Like here's the Bund. We had a key break above last week's high just before I got on the mic. Quite a decent breakout. 161.94 was the price. If I just add that to a shorter time frame chart here, 161.94. So we kind of went up and flirted and tested it earlier on, but quite a key, nice strong breakout, a good sort of 10-tick breakout as we test the 162 handle for the first time in the Bund futures history. So these are new all-time highs for price for Bund futures. It's not all-time low for yields, but it's all-time high for price. And so the risk off is definitely back on the agenda this morning. But we do have some gaps here on some of these European markets, which might be interesting later on, depending on how things go, obviously. So definitely a risk-off vibe here with it being led by crude oil. Keep your eyes on that. We have had some news flow on crude this morning, like the Kuwaiti OPEC governor saying it's difficult to hold a meeting on production if there's no agreement on cuts. And of course, that pretty much sums it up. There is no agreement. Saudi pretty much carry on insisting so. In fact, yesterday, Saudi Arabia said that they're actually going to increase their investment into the crude oil production facilities. So when you got the rest of the world dramatically reducing capex. Saudi are going the other way. We got Halliburton reporting numbers yesterday, and well, painful. 2015 they lost $666 million. 666. They should be scared about that as a number, and reported that obviously 2016 is going to continue to be painful. Bear in mind, like in 2014, when oil was up above $100 for at least half the year, Halliburton pulled in a cool $3.4 billion profit. So the thing about this oil industry is the giants can weather the storm. You know, when in 2014 you make 3.4 billion profit, you know, you can take a hit of 660 million in a year or even 2 years, right? It's the big guns that can weather this storm. It's the small guys that are struggling, and we've got more moves on the high yield US energy space. The high risk energy credit continues to widen, and you know, just you've got credit rating agencies, you know, threatening downgrades, and I don't know, as of yet we haven't really had a major sort of default event, and oil staying below 30 for, you know, we can't go too long. I mean, maybe a month, maybe, I don't know, it's hard to say, I'm just kind of guessing here, but maybe a couple of months below 30, and surely you've got to see some headline casualties, which could be a pretty interesting, you know, another chapter in this story. So anyway, lots to be worried about, and you can see, I can see a measure of the worry here. This is a good chart picked out of Twitter this morning. This is people searching bear market as a search term in search engines, mostly Google, of course, and check out this chart and check out the financial crisis here. So the frequency of the search term bear market has gone through the roof at the start of this year. We're not quite up to financial crisis levels here, but I tell you what, we're not far off. And you can see that this is easily, and you can see this by the measure of the VIX as well. You know, this is easily the most worried we have been about the global system since the financial crisis. It's an absolute fact. It's not the most worried we've been about the Eurozone. We've been more worried about the Eurozone, that is for absolute sure, back in 2010, 11, 12. But when you're talking about the whole world economy, we definitely have not been this worried since the financial crisis. And this is a measure of that. And this can be used as a measure of sentiment because, you know, I showed you that chart of the search terms for Brexit the other day, and how that certainly helps to explain this chart, which is an absolute collapse in the value of sterling as we've gone into 2016. And as the frequency of the search term Brexit spikes, well, then the bearish sentiment towards this currency increases, and of course downside pressure ramps up. So as I've finally fetched up on the cable chart, now's the time to have a look at the calendar. Let me bring this in. We'll come back to that cable chart in a second. This morning, there's no data, really. Well, there's no data at all. Absolutely nothing. Okay, we got some US stuff this afternoon, which I have to be honest, doesn't whet the appetite particularly until actually, yeah, we got consumer confidence actually, so that's interesting. So that'll be coming. Yeah, forget about these bold. Yeah, they've kind of screwed up the timetable for today. Forget about the bold case Schiller. It's the consumer confidence that really should be in bold here. We had the wasn't the Dallas Fed yesterday? Anyway, we had one of the lesser regional Fed numbers yesterday. I thought it was Dallas, but now I see it on this calendar. Maybe it wasn't. Anyway, it came in at levels we haven't seen since April 2009. But, you know, so the US data, I guess, continues to be mixed because don't forget we had a phenomenal payrolls report again at the start of the month. So you are getting labor market strength. It's just elsewhere things are again looking pretty dodgy. But consumer confidence coming in at 3 p.m. This will be the most important data release. These other housing numbers, the FHFA and the Case-Shiller numbers, these aren't particularly important. I guess we get the services PMI numbers at 245 actually as well. So it'll be interesting to get a read on that. Now, because of no data, really, it might be Carney that takes center stage this morning. So Carney's talking in front of the Treasury Select Committee, talking about, well, the UK economy, talking about Bank of England monetary policy, talking about the risks ahead. I was just reading in the FT, he's speculation he's going to be talking about the buy-to-let housing market in particular, worrying about how leveraged that's becoming, talking about major risks, over the long term. If interest rates rise, then the buy-to-let borrowers might start feeling the pain. But the reason why I laugh is because the idea of interest rates rising at this moment in time seems very far-fetched, and another reason why sterling is devaluing, of course, because Carney just last week said now's not the time to raise rates. So we've pushed our expectations on the Bank of England joining the Fed on trying to start a rate hiking cycle. That's been pushed at least to the end of the year, if not into 2017. So another reason why you've got sterling weakness is Brexit risk, it's delayed rate hikes, and Carney's going to be talking this morning, and that's going to be important. So bear in mind, I'm just going to show you a very long-term chart before we go back to the shorter one. We have made a new 7-year low here, of course, over the last week, breaking below the 2010 low. So the only barrier left, well, we've got the 140 handle, of course, and then it's 135, which was the credit crunch low. If we just go to a 1-hour chart, we've certainly seen cable come off that end of week high. You can see this is very, I guess, very correlated to sentiment at the moment. We've had a risk on rally at the end of last week, and now we're getting a risk off sell-off. We're back below the 142 handle here, and on the back foot as we wait for Carney, but that's not going to be for another couple of hours. 10:45 he's talking. Look, so I guess I'll leave it there for now. So no data, remember, 10:45 Carney, minor data out of the US until we get to kind of 2:45, 3 o'clock. The other big thing to remember about today is it's Apple Day. So they're reporting earnings tonight. There's been a lot of concern about this. There's been a lot of growing chatter about how, is this the beginning of the end for Apple? Is this the start of the decline, the Nokia-esque decline? There's a lot of people worried about, of course, their exposure to China. There's a lot of people worried that they're just a one-trick pony and all they do is sell phones. And they need a new product line, and the Apple iWatch failed. And what's next? They're trying to throw money, what seems to be in a reckless, haphazard manner, at driverless vehicles just because Google are doing it. And have they lost direction? Blah, blah, blah. Lots of doom. The market sentiment as a whole is responsible for some of that, but certainly Apple's earnings is always top of the list at earnings season. This is coming tonight, and certainly can help to drive negative sentiment if the closer we get to the close tonight, the more nervous we become. So Apple Day is with us. All right, guys. Keep your eye on oil, though, in the meantime. Enjoy the session.